This is frightening. I'm your host, Steve Van Metre, and thanks for joining me today. Our lead story today, the Unimaginable, is about to affect tens of millions of credit card holders. I'm going to show you what this is and what it means to their household finances and why it's going to be so damaging to their credit scores and the broad economy. And yesterday we brought you Imix Biopharma. Today their stock is up big on its way back to all-time highs. And one of our recent sponsors, Spectre Holdings, at one point today their stock was up over 50% on some news that came out this morning. Today my team brings you Metre AI, and we know AI companies are going to be a big focus of Wall Street and investors, making this the early time to get in, because we're going to show you a setup where we think this company stock could go up 10% before it reaches a point where it has a massive breakout. You can find them on the OTCQB under the symbol MBAIF. Check out the pinned comment in the description for more information. Now let's head over to Bloomberg, where he picked today's story up with the headline, Chasing Economists Hopeful for U.S. Soft Landing and Fed Rate Cuts. Many thought that a recession was needed to bring down inflation. Now you might be wondering, well, what does this have to do? What's going on with credit card holders? Well, it has everything to do with what is coming for them. It's going to be damaging in a big way for tens of millions of cardholders. And we didn't really understand why inflation spiked in the first place. This, according to University of Michigan professor James Hines. We maybe shouldn't be surprised it came down faster than we thought. And one of the issues we have with periods of high inflation is it puts people behind when it comes to their paychecks. And in order to keep up with inflation, the first place they turn to is their credit cards. And this is important to understand, because as we look deeper here, during a post-mortem on what economists got wrong last year, Northwestern University professor Janice Eberly told the conference the profession relied too heavily on computer models built on past economic relationships. Those suggested recession would be needed to break the back of inflation, just as occurred in the 1970s. And of course, we know these same computer models are what the Fed uses to direct monetary policy. And this has become a massive problem. As we're seeing in the economy, things are starting to slow down in a big way. But yet we continue to hear now from the political elites that everything should be okay, that consumers should be happy because finally wage growth is above inflation. They just don't understand the big picture of what's going on and the situation that now tens of millions of cardholders are facing. And we should have never trusted our models, as according to a former U.S. Treasury official, suggesting that they suspected at a time they were too pessimistic. And models are drastic simplifications. In a paper he presented at the conference, Columbia University's Martin Uribe proposed extending the period covered by the models to before World War II, when inflation spikes were more common and when a pandemic previously struck. Of course, they just have no clue. And what this means is they put consumers in such a dire situation. They forced them to go onto their credit cards, and now what is coming to them is going to be outright devastating, not just to their household finances and their credit score, but to the broad economy. But hope remains in one space, and that is the AI space. Is why now is the time to invest in AI technology? Well, the answer is simple. The timing of AI investment is critical. The technology is at an inflection point, meaning it's early, where the capabilities of AI are expanding and the costs of implementation are becoming more reasonable. This convergence creates a window of opportunity for savvy investors to capitalize on the transformative potential of AI, and we believe that is going to be one of these companies is going to be Metre AI, again on the OTCQB under symbol MBAIF. Let's continue on, because at the 3-day annual meeting of the economics profession that wrapped up in San Antonio, numerous participants acknowledged the difficulties they faced in predicting the outlook for the economy and inflation in the post-pandemic world. Now, this is important to understand, because what we see is consumers have charged a lot on their credit cards. And why have they done this? Because they believed in the broad narrative that the mainstream media and the political elites have been telling them, that it's okay. We know things did not go right, but they're going to get better. There's going to be a soft landing. Your job is safe. Your wages are going to grow, and inflation is going to come down. So when consumers hear that, that has told them it's okay to go ahead and run up your debt, because there is a point in the near future that you're going to get ahead. But many failed to anticipate a burst of inflation to multi-decade highs, and then mistakenly believed that it would take a recession to bring it back down. And perhaps that is going to be one of the biggest fears, is that we are indeed facing a recession, which is what is coming for cardholders is going to be outright terrible. And here we can see inflation indeed coming down as we look at the net percentage of domestic banks tightening standards for commercial and industrial loans to firms of all sizes. This shown in blue, and anytime it's above that horizontal black line, that means banks are tightening standards. And what that means to you and I is that when we go down to get a loan, the answer starts to become the word no. And because commercial banks create money when they originate loans, well, by the fact that they're originating fewer loans indicates that we don't have enough money to cover all the debt, being a big problem for credit card holders, and to sustain the growth the political elites tell us we will. And as a result, what we see historically, we don't need fancy computer models. What we need is just a very simple chart that shows when there isn't enough money in the economy being created, well, demand goes down and inflation goes with it. We see that here in the dot-com bubble, the global financial crisis, going into the pandemic, we see the same effect, and we're seeing it now almost in synchronized fashion as banks cut the creation of credit. Lo and behold, inflation comes down. And with that, it also means the unemployment market is going to change, and labor, as we hear again from the political elites, that your job is safe, you have nothing to worry about, all this debt that you've drawn up, it won't be a problem because inflation will come down, the good times will be back, you'll be able to pay your bills. Well, look at what happens historically when we see demand come down, and this is the part they miss, because we see consumer price index in red. That is our proxy of demand. It comes down. Why? Because more people are on continued claims, as shown in blue, and of course, the more people on unemployment, well, the less money they have to spend. Again, you see demand coming down. As we look into modern times, we see it sync up as continued claims rise. Well, the consumer price index falls. We'll note that only going into the global financial crisis do we see a little bit of a different effect because of crude oil, but then we saw massive deflation occur shortly thereafter, and now at the same time banks were tightening standards, there's less money, not only in terms of credit creation, but to sustain the labor market. Well, continued claims are rising, unemployment claims going up, as well as inflation coming down. Now, of course, what does all this mean for credit card holders? Well, this is a huge problem, because 56 million credit card holders have been in debt now for at least a year, according to a recent survey. This being a big problem because normally when credit card holders get behind, some of them are able to catch up. And what we're finding due to inflation, which is why I wanted to cover how the economists got this wrong, and then they told the political elites what they needed to do. They over-tightened, they inverted the yield curves, they inverted the money curves, and now they're setting the stage for what is going to be a dangerous move, because the next thing to go is the labor market, and this is going to put tens of millions of credit card holders into a big financial problem. Although Americans helped stave off recession in 2023 by spending enough to propel economic growth, it has come at a cost. Nearly half of consumers say they're carrying credit card debt, according to a recent survey from Bankrate. The personal financial firm found that 49% of credit card users carry a balance from 1 month to the next. That's up a full 10 percentage points from 2021. So this is a big deal, because it's telling us if we were looking for any evidence of a soft landing or a resumption of the bull market or the economy really turning into the expansion that the political elites are telling us, we should not see this in the data. So what this is telling us is the average consumer is struggling in a big way. They're taking on more debt. They're not able to keep up because their wages just aren't growing fast enough. And that is telling us that, of course, the unimaginable is about to happen. And of those who revolve their balances, 58%, or about 56 million people, have been in debt for at least 1 year. But one way maybe out of that would be an investment in companies like Metre. Again, we know some of our sponsors, their stocks just keep going up, creating opportunities as Metre invests in health and technology companies, changing how care is delivered. They focus on the intersection of healthcare and technology to match personalized patient needs with enhanced revenue opportunities. And right now, they have investments in 4 AI companies focused on the healthcare sector, and you can be a part of this. Again, they're on the OTCQB under symbol MBAIF. We'll take a look at their stock here in a moment, but let's keep looking at just what this means for cardholders as they look to get swamped in debt under the hopes the economy was going to turn around, maybe only to find out the reality is it's not going to turn around at all. In fact, it's going to get worse. A vast number of Americans racking up credit card debt isn't a sign of reckless spending, which, of course, normally it is. The most common reason for not paying off their plastic every month now is facing emergency or unexpected expenses, such as medical bills and car repairs, this according to respondents. And what this means is they have no savings. Now, remember all that pandemic stimulus, it went into savings accounts. We've talked about how savings are being drained. Now they have. And why did this happen? Is because people bought into the belief that the economy was going to boom, they're going to be able to refill their savings, so they were able to go out and spend some of it to keep up with inflation, and now they're finding out it did not work at all the way they thought. And when you start to think about all of this debt that's piling up, well, it comes with a cost. And here's the part that, of course, we know the political elites just don't understand that for a nearly 2-year period, inflation outpaced what was, of course, total compensation. This shown in blue, this is average hourly earnings and multiplied by average weekly hours of production and non-supervisory employees. This in blue against the consumer price index in red, both on a year-over-year rate of change. And so for nearly 2 years, consumers did not keep up with inflation because they just spent too much money on that pandemic stimulus, not believing that inflation would go this high. Well, now, of course, what do we hear from the political elites? That, well, everything should be good. The problem we have is people are under a mountain of debt. And the problem, if that isn't just the size, it's the rate of interest they're paying. Overall, Americans owe more than $1 trillion on their credit cards. For the first time, consumers have surpassed that combined level of debt. This according to the St. Louis Federal Reserve. And the average credit card annual percentage rate has now hit a record 20.74% in 2023, a 4.44 percentage points from early 2022. Of course, that means minimum payments going higher. That means that is less discretionary money coming out of the economy at a time when we know total compensation growth continues to slow. So this is setting up household finances now to get in a crunch where they're going to have to cut their discretionary spending. There's no way out of it. But the problem is, for some of them, there's nothing left to cut, setting up what's going to be the unimaginable. As inflation is making an existing trend worse, this according to Bankrate, we've been seeing this for a while. With more people carrying more debt for longer periods of time, it's moving in the wrong direction, again suggesting the economy is headed in the wrong direction. But one thing we think is going to head in the right direction, that is the stock of our sponsor, Metre AI, again on the OTCQB under the symbol MBAIF. Here you can see the 2 supply zones. Now we're looking at their 6-month chart. You can see where the buyers are at here, right between around 17 to 18 cents. Sellers here above, right around 20 to 21 cents. That is their all-time high, and that's just how close they are. And we know when stocks break out of a supply zone, well, they move a whole lot higher, and they do it very, very quickly, which is why we're suggesting that Metre could see a 10% move from where it's at today back into that supply zone around 20 to 21 cents, and a break out there would be a huge return for investors, as we note that AI technology is not going away. It's the darling of Wall Street, and investors getting in early can take advantage of that. And you too can take advantage of Metre. Again, check out the pinned comment or description below, because here we can see this is the issue for credit card holders, is they can't get more credit, and so they've had to go look elsewhere. So now we're going to look at total compensation, still shown in blue, against the net percentage of domestic banks tightening standards just for credit cards cards now in red. Anywhere above that dotted green line is where the banks are tightening standards for credit cards, which means when you want to raise your limit or get more credit, the answer is usually no. And this has put consumers at dire straits financially. They're finally seeing some hope on the inflation front as it cools off, and they're holding their jobs and their wages still are growing. The problem is they've got a whole bunch of debt behind them. They're still playing a little bit of catch up and they need some more margin, but the banks keep saying no. And this is an issue because when banks constrict credit, well, at some point, consumers have a problem. And the problem is as their wage growth goes down, and this is what we're being told by the political elites is not going to happen. But what I want to suggest to you, as we face consumers spending less money into the economy because their discretionary spendable money is going down as their wage growth slows, prices stay elevated, and their higher cost of debt service have an impact, what that means is they spend less on the economy. And if they spend less, well, that's less income for other people. And that means a further decline in wage growth as banks look to squeeze them about making their payments. And this means Americans are then forced to start racking up more phantom debt, which could be a huge problem, especially since we have no way to track this. So again, to get through inflation, Americans took on a mountain of credit card debt, and then they turned, of course, to phantom debt. As buy now, pay later loans especially can be hard to track, making it easier for more consumers to get in over their heads. And even more than credit cards, which are simpler to account for despite sky-high interest rates. And over the holidays, the use of installment payments hit an all-time high, up 14% year over year. And buy now, pay later is one of the fastest growing categories in consumer finance, this according to a report by Wells Fargo. And because no central repository exists for monitoring it, at least not for right now, growth of this phantom debt can imply total household debt levels are actually higher than traditional measures. So you start to see the setup here is we're going to see a continued decline in total compensation at a point where there are massive debt levels. And even though, of course, the political elites are telling everyone, hey, you should be getting ahead now, we know that that is not an instantaneously effect for households. Just because you can now perhaps maintain the status quo doesn't mean you don't have emergencies come up. We know, of course, there's no savings left for that. Of course, that leads people to doing phantom debt just to get by. And since buy now, pay later loans are not currently reported to major credit reporting agencies, again, something I believe will change in the future, it makes it a challenge for a lender to know how many loans a consumer has outstanding, meaning consumers can borrow more, and more without any restraint. And it's hard to know how much of this debt is out there. It's kind of a shadow debt that's hanging over people. And until there's a definitive measure for it, there's no way to know when this phantom debt could create problems for the consumer and the broader economy. Of course, I disagree with that. I can tell you, we don't know exactly when, but I'm going to tell you how, because what is the unimaginable that tens of millions of credit card holders are going to face? Well, they're going to enter delinquency as they are unable to make their payments. And how do we know that's going to happen? Because they're going to cut their spending. That's going to mean less money spent out in the economy. More people are going to stay on unemployment and find their way to unemployment. And that, my friends, is indeed the unimaginable. And here we can see it as total compensation still shown in blue now against the delinquency rate. That's going to be on a year-over-year rate of change, because I want you to just see just how much it moves as total compensation growth slows. That means tens of millions of credit card holders are not going to be able to make their payments. Not to mention, they've got all this phantom debt on top of that. You see the year-over-year rate of change on the delinquency rate of credit cards goes up. You can see that happen again during the dot-com bubble in a big way during the global financial crisis. And look now, it is outright surging, almost 48% year-over-year rate of change as compensation growth slows. And so as people spend less, their compensation growth goes down. Of course, that means more in delinquency, and tens of millions of credit card holders are going to be forced to do the unimaginable, which means we know the Federal Reserve will eventually have to drive rates down so people can keep making their payments. Because when they start going into delinquency, what that means for the banks? Well, it means insolvency. And of course, we note that this all comes back to the fact that the central elites have inverted the yield and money curves, and that leads us to Fed's Logan saying the quiet part out loud, this from Zero Hedge, and buried on Saturday morning amid the hubbub of politicians and media scrambling to signal their virtue over the third anniversary of January 6th. Dallas Fed President Lori Logan dropped a couple of tape bombs that suggested Powell and his pals are worried about more than just jobs and inflation. And what could they be worried about? Well, a simple answer, something we call liquidity, meaning there's just not enough money in the system. And that's what I want you to understand is many people say, how come this hasn't happened yet? Well, it will once all the money's drained out of the system and the debt of a debt-based economy starts to consume and eat away what little money is left. Next thing you know, things go wrong in a big way. And liquidity is draining too damn fast, Zero Hedge says. And while there's still more than enough liquidity in the financial system, individual banks could start to see constraints, which is no surprise because we know small and mid-sized regional banks are insolvent. She said it's now appropriate to begin discussing the parameters around a Fed decision to slow the pace of its balance sheet runoff. In my view, she said, we should slow the pace of runoff as overnight reverse repo balances approach a new level, referring to the Fed's overnight reverse repurchase facility, a place where counterparties such as money market funds can park excess cash. Why this matters, I don't know, because all they're doing is looking for collateral. So as Janet Yellen issues more T-bills instead of refinancing everything at the intermediate and long end of the curve, there should be no factor here with overnight reverse repo. Just to illustrate the point, the central elites have no clue how to run the system that we put them in charge of. And normalizing the balance sheet more slowly can actually help get to a more efficient balance sheet in the long run by smoothing redistribution and reducing the likelihood we have to stop prematurely, she added, suggesting they're starting to panic because they have no idea what's going on. And now we see this in the oil markets today. Remember, it wasn't long ago when all of a sudden all the experts are saying oil was going to get a hit 100 barrel and then 250 and maybe even more. Now it's going down. As oil plunges after Saudi Arabia cuts oil prices for February amid persistent weakness, and we mentioned this, the economy was going to get weaker, and now it's starting to show up in the oil market. Despite the fact we've seen production cuts, demand around the world is crumbling. And the news outlet noted that the price cuts is the deepest in 13 months and suggests a softer Asian market for crude. Of course, we know the Asian market demand there is going down. And what that means for the economy, it means it's getting weaker. And when that gets weaker, more people on the unemployment line, more people can't make their payments on their credit card. Here's the evidence of that as we look at real gross domestic product in blue against crude oil prices, that being West Texas Intermediate in red, both on a year-over-year rate of change. And you can see the oil market tends to lead the broad economy, suggesting GDP growth is coming down. And of course, we know that West Texas Intermediate feeds right into gasoline prices, which feed right into a big part of the consumer price index. Now we'll swap out GDP for the consumer price index in blue, suggesting that as crude oil prices head lower, well, that means inflation comes down. That means more jobs on the line and total compensation growth all head down. Again, putting tens of millions of credit card holders facing the unimaginable of being unable to make their payments. Of course, we know the Fed will eventually respond, but for too many households, it's going to destroy their credit and their finances, all thanks to the central elites. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. And always keep in mind that any company we feature on this show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. Bye now.